Can you buy a house using alimony and child support? Absolutely, but only if the terms of your divorce align with mortgage rules. And far, far too often I see divorce decrees that don't. If you hope to buy a home on the other side of your divorce, or if you've agreed to a refinance to keep your home once things wrap up, this is a big, big deal. Get things right, and you could be approved for a loan and ready to close the moment the ink dries on your divorce papers. Get things wrong, and you may never be able to use your support payments to qualify for a mortgage. And that's the point of your support payments in many instances. Here's a disastrous situation I hate seeing. Let's say you and your ex agree you're going to keep the house and buy out their equity. If your support payments aren't set up correctly and you can't qualify for a loan, you could wind up in a really bad jam, legally obligated to something that isn't possible. You could wind up back in court and be forced to sell your home and move. Now, I was inspired to record this video by a conversation I had recently with a new client. She reached out to get pre-approved to buy a home. Her divorce was just finalized, and she'd received her first alimony payment like a few days before we talked. Rock and roll, right? Let's go shop for a house. She was pretty bummed out to learn that, nope, her support payments can't be used for a home purchase. So let's make sure you don't face this potential for frustration and for heartbreak. Decisions you make during this emotional but relatively short period of time have ramifications that can last for years. In this video, I'm going to break down everything you need to know and share a trick or two, including one that can act like a time machine, sort of, seriously. And I'll also talk about how different types of support payments are figured into the loan process. So watch to the end and I'll cover everything you need to know. But before we dive into the details, I want to point out that this video is part of a playlist about divorce, mortgages, and real estate. My goal is to protect your credit and preserve your homeownership eligibility as you navigate your divorce. Please like and subscribe so you don't miss out on any of this content, and help the YouTube algorithm share this information with others. And if you're looking for a mortgage, maybe you found your loan officer, use the link in the description below to schedule a call. And the sooner the better. Early in your divorce negotiations, you'll start making decisions that are difficult, if not impossible, to reverse and unwind. And these can make or break your ability to qualify for a mortgage. So let's get to it. Starting with a footnote, the Equal Credit Opportunity Act forbids lenders from asking if you receive child support or alimony without first telling you that you're not required to disclose that you receive child support or alimony. Kind of feels like the first rule of Fight Club, doesn't it? This law was passed in 1974 with the goal of ending discrimination and bias in lending, including marital status. And I suppose somewhere, someone out there may still find divorce scandalous, which is really where that part of the rule came from. But these days, the rule just feels a little more like a quirky legacy of another era. But now you know why your lender will tell you that you don't have to talk about Fight Club before asking you about Fight Club. Now, I'll never argue that mortgage rules are completely logical. Often they're not, but when it comes to the income that we can use to qualify you for a mortgage, there are a couple of foundational ideas that do make sense and can be a good way to frame up this topic. Income used for mortgages, any income used for mortgage qualifying, has to be stable and ongoing. And the ongoing part is what we lenders call continuance. And this makes perfect sense. Your lender needs to have a good handle on what your income will be, that's the stability part, and that it will be there to pay your mortgage payment in the future. That's the continuance part. For support payments, continuance is easy to show. There's a document, a judgment, a support order, a divorce decree, a separation agreement, something like that, awarding you the support for a specified period of time. Stability is trickier to establish. Your receipt of support payments depends on your ex's willingness and ability to pay, in effect, their creditworthiness. If they don't pay, or if they're a deadbeat, flaky, have trouble holding down a job, and don't have the ability to pay, their payments to you won't be stable. So to establish stability, since we can't really look into the future and see what's going to happen, we need to do the next best thing. We need to see a history of payments. If we can see your ex has paid you reliably, we're happy to presume they'll continue doing so. So we want to get into some of the specific loan rules now, and I'm going to start with continuance. Loan rules for continuance are actually pretty universal. Any income used for loan qualifying must continue for at least 3 years after closing. And this 3-year rule is really strict. If you fall a day short, let's say your child support ends when your kid turns 18 and you buy a home on your daughter's 15th birthday, you'd be a day short of 3 years and your child support for her won't count toward your loan. Although this 3-year requirement is universal, the date from which it is measured varies just a little bit by loan type. Conventional loans are the most generous with timing. Support has to continue for 3 years after your application date. And your application date is the day you provide your lender with all of the information needed to start your loan. There's actually a legal definition of the list of things. It's your name, your income, your social security number, so your lender can pull a credit report up, the property address, an estimated value for the property, and the amount you want to borrow. Check those boxes and you've made application. It can take weeks or, in unusual circumstances, months to process and then close on a loan, but as long as you get the ball rolling early enough, your support payments can remain in the mix. Most conventional loans are funded with money from Fannie Mae or Freddie Mac, probably familiar names. Fannie and Freddie set a maximum loan limit every year. Loans above this threshold, the limit that Fannie and Freddie set, are called jumbo loans. Most jumbo loan guidelines do follow Fannie and Freddie rules for continuance, but there are some exceptions. I've seen a few jumbo investors that require as much as 5 years in some jumbo loan guidelines. Loans insured or guaranteed by the government key off of the closing date. For FHA and USDA loans, we're required to have 3 years of continuance from the date on your final closing disclosure. That'll be the date you legally take ownership of the property. VA rules are a little wishy-washier, and wishy-washy rules are kind of a VA thing. They leave a lot open for lenders to interpret as long as we're acting in the best interest of the veteran and their family, but their guidelines specify the anticipated closing date. Now, I've never had to test this theory out, but that squishy language about the anticipated closing date could potentially come in handy if you're getting a VA loan and your closing date is delayed due to a repair to the home or some other unforeseen issue that comes up and pushes your closing date back from the anticipated time frame. And I'll talk more about this in a minute, but one other important consideration when it comes to continuance is the level of support payments you receive. If your support steps down over time, and spousal support often does, or you receive child support for more than one kid, lenders will only count the income you'll still be receiving 3 years in the future. And again, more on this in a second. But first I want to talk about documenting stability. As I mentioned already, documenting stability is something that we do by looking backward. So first I'm going to talk about the rules, and then I'll talk about how frustrating and potentially disastrous setting up support without understanding these rules can be. The rules themselves vary. You can think of these rules as the minimum timeline required to establish that your ex is creditworthy and can be trusted to pay what they owe you reliably so that you can count on it to help make your loan payment. And first, an important detail. In lending terms, on time means paid within 30 days of the due date. So if support's due on the 1st, but your ex gets paid on the 15th and pays you right after that every month, that may be annoying and technically late, but to a lender, that's still on time. But if your ex falls behind and then pays a few months at a time, even if they're super consistent about paying, if any payment is 30 days late or later, it's not considered on time for lending rules. Now, Fannie Mae and Freddie Mac require that we document that you've received the most recent 6 months of payments in full. If you've received full, regular, timely payments for 6 months or longer, your support's considered stable and it can be used toward your loan. Partial or late or inconsistent or sporadic payments are not acceptable. They don't check that box for Fannie Mae. And again, jumbo loans usually follow Fannie Mae rules, but some may want to see even more time. I've seen 9 or 12 months of receipt required in some jumbo guidelines, and that's kind of a theme. Jumbo loans will be Fannie Mae or Freddie Mac consistent or more conservative. Now, government issue programs are actually more generous. FHA loans only require 3 months of payments, and FHA rules are generous in a couple of other really huge ways. If your ex or co-parent is paying voluntary, non-court ordered support, FHA may consider this income if you follow certain rules. And I've made a video dedicated to this topic, which you can watch here. And if the payments you've been receiving haven't been entirely consistent, maybe you get partial payments some of the time, or your ex pays late every now and then, FHA may allow your lender to average what your ex has been paying to you over the last couple years. And that is flexibility that Fannie Mae and Freddie Mac don't permit. Now, USDA rules require proof that you've received 6 months of payments. In that way, they're like Fannie Mae, but like FHA, they'll also allow lenders to average inconsistent payments. And USDA also has rules that allow non-court ordered voluntary payments as long as you've received them for at least a year. And the VA is the most generous and true to form vague. There's no minimum number of payments required, although many lenders will tell you 3 months of receipt is required. I really personally, this is not an argument that I've won with underwriters yet, but this is a misreading of the requirements for veterans paying support payments. Like I said, I haven't ever won the argument, so I think it's best to plan on showing 3 or more months of consistent payments, and that is logical. Again, we're establishing creditworthiness for your ex. And in typical VA fashion, they're not very explicit about how to handle payments that aren't consistent. They ask lenders to consider, that's their word, whether the payments are received per their written agreement, how long the payments have been received, regularity of receipt, and available procedures to compel payment. There's a gray area there that could give your lender leeway to include support payments with a less than perfect payment history, but it really is going to be an underwriter's judgment call. So let's say you check all the right boxes for continuance and stability. Awesome. Now let's talk about how much income we're allowed to count. Income calculations include 4 considerations, 2 of which are going to sound familiar: seasoning, stability, continuance, and taxability. First, your payments have to season over the requisite period of time. They won't come online as income for loan qualifying until you've received them over 3 or 6 or 12 months, depending on the loan option. And there's no shortcut here. Your ex can't just pay ahead and check this box. It's payments over time. Remember, we're trying to establish their creditworthiness. Before your support payments have seasoned over the minimum period of time, they count as 0 in income for your loan. But stick around and I'll share a nifty trick that can act as a sort of a time machine. Now, the next element is our old friend, stability. For conventional loans, the rules are really black and white. If any of the most recent 6 months of payments haven't been paid on time, your support payments can't be used for loan qualifications. They are worth 0. And remember our grace period. A payment is paid on time if it's paid within 30 days of the due date. And that's really important. We can get down to counting days sometimes if your ex is a little inconsistent with payments, but if they all slip in within that 30 days of the due date, they'll be on time and you can count them towards your loan. Now, FHA, USDA, and VA allow a little flexibility here. Like we talked about, if your ex has been a little irregular, lenders are allowed to average what they've actually paid over a period of time. And this time frame can be as long as 24 months for an FHA loan, as little as 6 months for USDA, and it's at the lender's discretion for VA. But in all cases, if your payments are too irregular, an underwriter could just decide they're not stable enough to count. So more stable is more better. And our other old friend, continuance, also figures into the amount of income your lender will use. Child support will, of course, phase out at a certain point, and your lender's only going to use the smallest amount of support you're scheduled to receive during the 3 years after you close on your home purchase. If you receive support for, say, a 10-year-old and a 17-year-old, and support cuts off at 18, the support for your youngest child will figure into your loan, but not for your elder. Now, things get fuzzy if support for your 17-year-old continues to 21, but only as long as they're in school, and that's really common. So if you can convince the underwriter that your son is headed off to college, his portion of the support may still count, but if the support shifts and is going to be paid directly to your kid when your kid turns 18, and that is also somewhat common, that income may not count. Now, continuance is also part of the conversation for spousal support payments, which very often step down over time. And the logic behind tiered support and the reason it's so common really makes sense. If you've been an at-home parent or the primary caregiver for kids and you're going to be going back to work or shifting from working part-time to full-time, you could benefit from higher support at first, but then less in the future as your career gets back into full swing. But from a lending standpoint, this can really be a problem. Someone who always comes to mind when I think about this issue is a client of mine who's a freelance graphic designer. She'd worked very part-time while her kids were little, and she was just starting to go back to work full-time as her kids headed off to school when she and her husband divorced. She expected her business to get back into full swing and kind of build back up over a period of years, so she negotiated support payments that started higher and then stepped down over a 4-year period. But for her loan, we wound up with the worst of both worlds. We had to look backward at her prior really low, really part-time freelance income, but then forward to the lowest support payment she'd be receiving during the next 3 years. And 3 years out, her support wasn't scheduled to be all that much. So the combination of that worst case history on the freelance income and the worst case history on what her income was going to be was not that much. At one point, her ex-husband, who was a super nice guy, contemplated actually co-signing for her so she could buy a home of her own, which was just going to leave them entangled in ways that they didn't really want. So ultimately we figured things out, but it took a combination of waiting until she could file another tax return with more income and then a really huge down payment that she was fortunate to be able to make. Now for some good news. The income tax status for the support payments you receive can give your income a bit of a lift. If a portion of your income isn't subject to income tax, lenders are allowed to count it at a higher level than taxable income. We call this grossing up the income. And the basic idea is that if you get to put more income into your pocket when you don't pay taxes on it, that income is worth more to you. Conventional USDA and VA loans allow untaxed income to be grossed up to 125%. FHA allows income to be grossed up at least 115%, but more if you can prove you pay a higher tax rate than 15%. So let's say you receive $1,000 of child support. Grossing that up by 125% means it's worth $1,250 for loan qualification. The different treatment of taxable and non-taxable income can be important if you're going to be receiving alimony and child support. If your divorce was finalized December 31st, 2018 or earlier, your alimony is untaxed and can be grossed up. But after that date, if you're getting divorced right now, you're going to pay tax on your alimony, so lenders won't gross it up. But child support is always untaxed and can always be grossed up. So your child support may wind up being set based on a formula that's determined by the state. But if you have the opportunity to negotiate a higher amount of child support relative to your alimony, every extra dollar you can slide over to child support is worth $1.15 to $1.25 in qualifying income for your loan. Now, let's talk about documentation requirements. We lenders love documentation, so any alimony or child support agreements have to be in writing. And the document that you put in writing needs to include the amount and the duration of the payment. So most commonly, this is going to be a divorce decree or a stipulated judgment, but it could be a separation agreement or a standalone support order of some kind. But whatever the case, plan on providing this document to your lender. And documents that are legally binding but not court-ordered can be used as well. Fannie Mae guidelines permit lenders to document support using, and this is a quote, any type of written legal agreement or court decree describing the payment terms, or documentation with applicable state laws that mandate support and specify the conditions under which payments will be made. For a conventional or a jumbo loan, you'll need to provide a fully executed copy of the entire document signed by you and your ex and the judge. FHA, VA, and USDA rules allow you to share only the front page and other pages with the details that are pertinent to your support, but I've really found that underwriters prefer to have the entire document even if the guidelines don't specify it. It's kind of their literal job to be nosy, and they just don't like not knowing what they don't know, if you know what I mean. And again, FHA and USDA rules do explicitly allow non-court ordered voluntary payments to be included as qualifying income so long as you follow some rules. And I've detailed all these rules in another video. I'll put a link to that in the description below. To prove stability of your support payments, you'll need to show a history of receipt over the requisite period of time. And lenders will take pretty much anything you can provide. We're actually pretty flexible here. Records from the state or other government agencies, bank statements with deposits, canceled checks, Venmo deposits, deposit slips, tax returns can even help. Cash payments, however, oh my goodness, can be super challenging. If your ex pays you in cash, deposit every payment to your bank account in full and right away. And this is really important. Let's say you receive the same amount every month, like clockwork from your ex, but some months you hang on to some cash as spending money, or you deposit odd amounts at odd intervals. Those really regular payments that your ex is paying you can look really irregular to your lender. So your best bet, honestly and truly, I mean, if you get cash deposited in full right away, but just have your ex pay you in a way that is easier to document, like Venmo or bank transfers or just an old-fashioned check. And child support also depends on the age of your kids, so plan on providing something showing how old your kids are. This is often really conveniently written into your support order, but if it isn't, you may need to dig up birth certificates or something else that shows their age. And if support for your teenager will only continue for 3 more years, if they're on their way to school, things can get a little bit weird. You may need to get creative with documentation to convince an underwriter that your 16-year-old is college bound. A college acceptance letter would be great, but if that's not available yet, grades, admission tests, a letter from the school counselor, emails about campus visits, you really can put on your thinking cap and get creative to see what you can dig up, because we've got to show that 3 years of continuance. Now, I mentioned I was inspired to record this video by a conversation that I had recently with a new client. Her divorce was just finalized, and she'd received her first alimony payment a few days before we talked. Now, I told her, I gave her bad news. She was disappointed to learn that she was not able to start a house hunt right away. But fortunately, the only problem was seasoning. She wanted a conventional loan and had only received 1 month of alimony, and she was disappointed to find that she was going to need to wait 5 more payments before we could use her alimony, which was actually her only source of income, to qualify for the conventional loan she wanted to use. Fortunately, she's in a comfortable living situation, so this delay is more of a disappointment than a total disaster. That said, she is so lucky in one important way that really could have been a disaster. She's scheduled to receive a total of 4 years of support payments. So she has a 6-month window during which she will have received the required 6 months of payments, but will also have the also required 3 remaining years of payments. If she misses that 6-month window by a day, we won't be able to count her sole source of income for loan qualifying, and she won't be able to buy a home. Now, remember I promised a time machine, so I want to talk about that. I wish I'd connected with this client earlier. If we'd started planning for her mortgage just as she and her future ex got the ball rolling on her divorce months earlier, here's what I would have suggested. As early as possible, figure out how much the support payments are going to be, and then have her ex, or I would have suggested her ex, start paying that payment right away. Then, when they draft the divorce papers and file them with the courts, put in the divorce papers a retroactive order, making support due beginning on the date retroactively that the first pre-divorce support payment was paid. Her divorce actually took about 5 months to finalize. So if she'd done this, she would have already received 5 retroactively court-ordered payments by the time that her divorce decree was signed, and she could have started her house hunt right away. This only works, of course, if your ex is agreeable, but it can fast forward your house hunt by 3 or 6 or 12 months depending on the loan program and how long your divorce proceedings take. But it can really act like a time machine. It's truly never too soon to start planning for a mortgage, but this is especially true when you're navigating a divorce. So use my contact information below to schedule a call, and thanks so much for watching.